In just 3 months, HP's shipments of AI PCs skyrocketed from 35% to 44% of their total mix.
Wow.
Yeah, nearly half of the computers they're shipping out right now are AI-enabled, which, brings up this massive multi-billion-dollar question. For a decade, the entire industry has been obsessed with moving everything into the cloud. So why are we suddenly rushing back to the physical desktop?
Well, it really represents a fundamental reversal in computing architecture. We are basically witnessing a rejection of this idea that the future of tech belongs exclusively to remote server farms.
Welcome, and thank you so much for coming to watch the video. We are thrilled you're here with us. Today, we're looking at HP's Q2 2026 earnings call, featuring interim CEO Bruce Broussard and CFO Karen Parkhill.
Yeah, and we are analyzing a company operating in just an incredibly complex, highly inflationary environment. But they're pulling off these strategic maneuvers that kind of defy standard economic logic.
Exactly. So first, let's summarize the company's prepared presentation before we get into the Q&A session. Because the financial results they highlighted are wild. I mean, they hit $14.4 billion in revenue.
Right, which is up 9%. And that's actually their 8th consecutive quarter of top-line growth. Plus, their EPS, their earnings per share, came in at 86 cents. That's up over 20% year over year.
Which is honestly the central mystery of this quarter. Because component costs, things like memory and solid-state storage, they are going through the roof globally right now.
They really are.
So how does a hardware manufacturer grow their personal systems operating profit by 30% when their raw materials are getting significantly more expensive?
Right. Well, in the prepared remarks, management laid out what they call their 4-pillar mitigation playbook. Basically, they built a financial fortress around their supply chain.
Okay, break that down for us. What's the first pillar?
The first pillar is securing long-term agreements for memory and storage. They essentially treated the component market like a futures market. They saw the global cost spikes coming and moved aggressively to lock in pricing for the entire fiscal year.
So it's kind of like a restaurant locking in beef prices right before a massive cattle shortage, right?
Yeah, exactly.
While competitors are buying memory at current spot market prices and losing their margins, HP is sitting on contracts from before the inflation hit.
Yeah, it's brilliant, and that covers the raw materials. But the second and third pillars, which are utilizing strategic inventory and real-time demand steering, those are even more interesting.
Demand steering sounds a bit like a corporate buzzword. How does that actually work?
It's basically like airline dynamic pricing, but for physical laptops. HP integrated their supply chain analytics directly with their digital storefronts. So if they suddenly have a surplus of, say, a specific solid-state drive in a warehouse, the system doesn't just let it sit there.
It actively pushes the consumer toward that specific part.
Instantly. They configure new laptops to use those surplus parts, and then they algorithmically direct their marketing spend to heavily promote those exact configurations. They literally make the consumer want what is cheapest for HP to build that day.
Oh, wow. That is fascinating. You completely remove the friction of predicting demand.
Right. And the fourth pillar builds on that, which is aggressive repricing. They selectively raise prices on enterprise customers and in regions where they had enough market dominance that demand wouldn't drop.
And management also highlighted their ongoing drive to generate $1 billion in gross run rate savings by 2028.
Right, yeah. That includes a recent voluntary early retirement plan. They're just relentlessly leaning out their operational overhead.
But, a brilliant supply chain only matters if you're building a product people actually need. Which brings us to the biggest strategic shift from the presentation, their pivot toward AI at the edge.
Yeah, specifically driven by something called agentic AI.
Right, because we're used to AI as a chatbot in the cloud. You type a prompt, it goes to a server, it comes back.
Exactly, but agentic AI systems are autonomous. They execute complex, multi-step workflows without you prompting them constantly. They scan local files, draft emails based on your calendar, monitor security.
And doing that continuously in the cloud is a huge problem.
It's catastrophic for 3 reasons: token costs, latency, and enterprise data security.
Let's look at token costs first. If an AI is running 247 monitoring data for 10,000 employees, you're paying cloud fees by the millisecond, right?
Right. Every single action burns a fraction of a cent in cloud tokens. At scale, the operating expenses are completely unsustainable.
And then there's latency. If your AI is doing live audio transcription in a meeting, you literally cannot afford the millisecond delay of bouncing data to a remote server.
It has to happen instantaneously on the device. And then the third barrier is security. IT departments are terrified of employees pasting proprietary code or sensitive patient data into a public cloud chatbot.
Yeah, the risk of a leak is just immense. So
Yes.
HP is monetizing that fear by providing sovereign AI, right?
Exactly. It's an environment where the company keeps total control over its data, entirely behind their own firewalls. At their HP Imagine event, they talked about partnering with over 150 software companies to build tools for this.
Specifically, tools that run on the PC's neural processing unit, or NPU.
Yeah, because if you run continuous AI on a standard CPU, your fan will sound like a jet engine and your battery will die in 40 minutes. The NPU is dedicated low-power silicon just for neural networks.
Like the GoodNotes integration they mentioned, where it does live audio transcription entirely locally, no internet needed.
Right. No token fees, no latency, no privacy risks. And for developers, they introduced the new Z workstations. It's basically a small data center in a desktop tower. Plus HP NearSense, which lets these local devices automatically connect to each other.
Okay, so that's the AI growth engine.
Yeah.
But where are they getting the cash flow to fund all this new hardware development? Because in the presentation, they pointed to the print division.
Which is usually seen as the unsexy part of the business, right?
Right. Totally. I mean, overall, print revenue was completely flat year over year, zero growth. But the operating margins are incredibly strong at 18.3%. How do you extract that much profit from flat revenue?
By ditching the traditional razor and blade model, they used to sell cheap printers at a loss and gouge you on ink. Now they are abandoning the low-end market and driving double-digit growth in tank printers.
Where you fill the reservoirs from bottles, right?
Eh.
So the printer itself costs more upfront.
Exactly. HP captures the profit at the point of sale now. And they're doing the same in the industrial sector with 3D printing. They introduced the HP Multijet Fusion 1200, which shrinks industrial 3D printing into a much smaller footprint.
But the real margin driver is their subscription model, the HP All-In plan.
Yeah, you pay a predictable monthly fee, you get the printer, and it automatically orders its own ink before you even realize you're out. It turns a one-time buyer into a highly profitable recurring revenue stream.
Okay, so the prepared remarks paint a picture of a flawless quarter. Brilliant supply chain, massive AI pivot, high-margin subscriptions. But the tone really shifted when we got to the Q&A session.
It really did. Wall Street analysts spent almost the whole time aggressively questioning the second half of 2026.
Yeah, so let's break down that Q&A session. We'll go through the major questions asked, who asked them, and how management responded.
Sounds good.
First up in the Q&A, we had Krish Sankar from TD Cowen. His question was basically challenging the whole narrative around AI PC demand. He asked about CPU supply constraints and whether enterprise customers are actually committing real capital to this transition.
Right. And management's response was super revealing. They said they're actively battling supply constraints for specific small core CPUs just to keep up with the demand for complex AI configurations.
Basically saying, if this was just marketing, we wouldn't be fighting for premium silicon. The demand for local compute is very real. Next up, we had Tim Long from Barclays. He zeroed in on the print division, specifically asking how inflation and component availability are impacting the shift toward those all-in plan subscriptions.
And management's response there was that they are leaning heavily into the all-in plans, specifically because it removes psychological friction. Even with inflation, consumers love the predictability of a flat monthly fee and not having to worry about buying ink.
Okay, then things got a little tense. We had Amit Daryani from Evercore. He brought up a really concerning detail. He pointed out that roughly 2 to 3% of the commercial PC revenue in Q2 was actually pulled forward demand.
Yeah, that's a huge metric. Enterprise customers knew price hikes are coming from memory, so they accelerated their purchases to Q2 instead of waiting for Q3 or Q4.
Right. So management's response was basically acknowledging this. They admitted they borrowed future revenue to beat inflation, which obviously creates a demand vacuum for the back half of the year.
And that vacuum is exactly what triggered the intense questioning from the next two analysts, Samik Chatterjee at JP Morgan and Eric Woodring at Morgan Stanley.
Right. They both asked very similar questions. Their focus was entirely on an expected margin trough hitting in Q4. They wanted to know how HP is going to handle rising memory, resin, and transportation costs when demand is softening.
Right. Management was very transparent in their response. They agreed that input costs, especially resin for plastics in the print division, are going to rise significantly, but they argued that their ongoing structural cost-cutting program will offset those inflationary pressures.
Okay, and then we had a merchant from Citi. Her question was about geographical performance because the regional breakdowns were wildly different.
Yeah, they really were.
She noted that the Americas were totally flat, but APJ, the Asia-Pacific and Japan region, surged 18%, and EMEA saw 6% growth. So she asked what was driving that divergence.
And management responded that it was almost entirely driven by the Windows 11 refresh cycle. Corporations in the Americas upgraded earlier. But overseas, companies are finally being forced by Microsoft's end-of-support timelines to buy new hardware.
They noted that 30% of the global installed base is still on Windows 10. That is a massive pipeline of guaranteed sales.
It really is.
But this brings up the glaring contradiction of the whole call. General PC demand is softening. Component costs are up. Resin and shipping costs are up. By all accounts, things look rough. Yet HP actually raised their full-year guidance to $2.90 to $3.10 per share. How did management justify raising guidance in that environment?
Their response is basically an aggressive bet on mix shift. They know overall unit volume will drop. They'll sell fewer physical boxes, but they are betting that the low-end consumer market will take the hit, while enterprise buyers will still pay $3,000 for a premium Z workstation.
So they're relying on the high price tags and fat margins of AI PCs to offset the drop in total volume.
Exactly. That, plus the print subscriptions and the $1 billion in cost cuts, is why they raise guidance. They believe they can outrun the inflation.
So to wrap this up on a high level, the main theme here is that Q2 wasn't just a lucky hardware cycle. HP gave a masterclass in supply chain execution.
Yeah, they used long-term contracts and algorithmic demand steering to defend their margins, and they're using that cash to fund a structural pivot to edge AI.
It's an incredible balancing act, defending the legacy business while pioneering a new computing paradigm.
Truly.
And looking at that paradigm shift leaves us with something huge to think about. We're watching tech giants spend hundreds of billions building massive centralized cloud data centers for AI right now.
Just sprawling server farms everywhere.
But if AI models are getting smaller and vastly more efficient, and our local PCs are becoming these powerful neural nodes, will those massive cloud data centers eventually become obsolete?
It's wild to think about. Will the future bypass the cloud entirely, replaced by a billion interconnected AI PCs sitting on our desks?
Natively processing the world's data at the edge. It's a deeply provocative thought.
Absolutely.
Thank you all so much for watching. If you enjoyed this breakdown, please click like, share the video with your network, subscribe to the channel, and stay tuned for our upcoming content. We will see you next time.